Hey guys, since September we've had a lot of up and downs in the markets. Mortgage rates actually had gotten as low as around 4.99 for a lower end credit score at the start of August, and that was 4.625 for a good credit score with a substantial down payment. Now, there wasn't a Fed meeting in September, and that caused a lot of worry within the market because the only thing that can happen at that point is bad news after bad news. You don't have any action by the Federal Reserve. And so people began to wonder what's going to happen with inflation. And as we saw, when the Fed did have a meeting in September, they came out very hawkish. They started saying that they didn't care if they crashed the economy in order to defeat inflation, they would do that. And the market reacted very badly to those comments. At the same time, you had markets around the world, Deutsche Bank, Credit Suisse, saying that they could collapse if there were further credit federal funds rate hikes, and so that they were asking the U.S. and the rest of the world to lay off of those going forward. The UK came out with a couple of tax credits that they proposed right away. They weren't saying how they were going to fund those, but at the same time, that caused a lot of uncertainty in the market. You have to start thinking about this. Is the worst behind us yet? Or, is there actually going to be a huge crash? And I've been talking about this for several months, that the numbers don't line up for there to be a crash. In housing, there could be, you've seen a reduction somewhat in certain markets, some more substantial than others. But across the board, I think you've seen about 6% decline in prices. They're still up, however, year over year on appreciation by about that same 5%. Um, the Fed has another meeting in November. They're going to raise the rates. Okay, now if you're not familiar that the federal funds rate is different than mortgage rates, I have another video that you can watch that explains what the difference is and how they kind of affect each other. Um, at the same time, in November, you're going to get your next GDP numbers and you're going to get core inflation numbers. Now, core inflation numbers came out just this week and they were hotter than expected. That caused markets to worsen as well. Alongside all of the UK news that they could be trying to do tax cuts right now, which would in turn be inflationary because that would incentivize people to spend more money, not slowing down the demand and furthering cost increases. Now, the real problem with having demand is that they're not meeting it on the supply end. So supply chains are the biggest factor at play here. And a lot of industries not having the inventory. That's what we've seen over the last year and a half. But what you're starting to see is obviously over the last couple of months, you saw lumber come down probably the fastest of any of these industries. But you're starting to see inventory creep up in automotive. You're starting to see car dealers actually their inventory has increased over 54% in the last 2 months. So you're not getting just a bunch of cars that were pre-ordered and then getting immediately shipped off the lot. There's actually cars that are starting to sit on lots again. And you're also going to see freight costs coming way down. That won't reflect in our pricing for a while, but all of these factors are actually deflationary and they could lead to the inflation numbers after this next month starting to come down. So we may have really seen the worst of what rates are going to do. Because also we measure inflation year over year. The numbers from summer of 2021 were very, very low. And actually in September and October was the peak one for the first time we saw inflation creep up. And if you remember going back to to March and April of 2021, the questions were first asked about inflation, and the Fed said that they didn't believe that there was going to be inflation at all. If there was any inflation, it would be transitory, and that they weren't worried about it. And that's what kind of led us into this whole situation. Now, as you see that come out over the next few weeks, including with the Fed rate hike, you could see mortgage rates start to come back down. In fact, the next 3 months, inflation was higher last year, and so the inflation readings are going to come out a little cooler than what we're thinking, and so we may have actually seen the worst of year-over-year inflation. Also, if we do get more inventory, or able to open up supply chains and actually provide more than sufficient amount of inventory in each industry, that would lead to distributors and manufacturers actually having to cut prices to get rid of some of their inventory. So just the same, going back to the car model, you're starting to see dealers actually getting below MSRP, and they're actually negotiating again. And I've seen several different articles and automaker sources talking about this, that you're actually able to negotiate on cars again. So there's been a lot of people that had pulled out of the market there. There's the same with the housing right now. You see a lot of people that are not putting their feet back in the market. Maybe they have 1 foot in, 1 foot out, and they're waiting on that to happen in housing. So you're not going to have a crash here, but what you're going to have is a lot of people trying to time the market. So even with rates where they're at right now, there are several programs out there that you can look into in order to lower your mortgage payment if you did buy something. There's something called 2-1 buy down that lenders are offering. There's seller concessions, things like that can actually still get you in ahead of the game, because when rates start dropping, guess what? The competition goes up. And that's where we're really at. And so we're going to see some relief from all the headlines and from all the pressure that we're feeling in the next few months. Some people are predicting doom and gloom and destruction. Obviously, a lot of news companies are pushing that, and that's because that makes money. So, we also have elections coming up in the U.S. That plays a big part of this. Once they know that the policies could shift, opening up oil and gas on U.S. soil again would be very deflationary. It would cause prices to go down significantly, because you're opening up the supply side on that industry. Now, that may not be at this election with Congress and the Senate, because that is an executive action by the president. But it's things like that restrict the supply of goods, and not incentivizing these manufacturers and distributors to be able to grow to meet the demand is a big part of this as well. So we should see that start to come down, but there's a lot of people still waiting on the sidelines. So still expect a competitive market going forward. And like they say, if you're looking at cars or housing, you need to have a long-term outlook at all this. Okay? So if you have any questions about what you think we may see, or maybe you have opinions that disagree with mine or agree, or let me know what you think, put a comment down below and I will try to respond to all of them. Thanks very much.